Hello everyone. Welcome to the Stock Minds web channel. Investors hunting for high-growth technology plays with improving fundamentals may want to give Affirm Holdings, Nasdaq AFRM, a second look. After years of operating losses, Affirm now appears to be on the cusp of sustainable profitability, as seen in its latest quarterly report in Q4 fiscal 2025. Its strong revenue growth, improving free cash flow, and favorable valuation multiples all point to a stock with compelling upside, yet it still carries risks typical of fintech or lending businesses. In this video, we will dive into Affirm Holdings' recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About Affirm Holdings. Affirm Holdings was founded in 2012 by Max Levchin and others, with the mission of rethinking how consumers finance purchases. The company operates primarily in the buy now, pay later (BNPL) space, offering installment loans at point of sale with a transparent structure. No hidden fees, no compounding interest. Affirm services are integrated in e-commerce, point of sale kiosks, and via virtual or physical credit or debit cards. It makes money through merchant fees, interest income, and financing spread, for example the interest earned minus funding cost. Affirm financial performance. Affirm Holdings reported a strong set of results for Q4 2025, which ended in June 2025, highlighting its rapid transition towards sustainable profitability. Revenue for the quarter reached $876.42 million, up 32.95% from $659.19 million in Q4 2024, while EPS improved to 20 cents, a sharp turnaround from minus 14 cents a year earlier, reflecting a 242.86% increase. On a trailing 12 months TTM basis, revenue climbed to $3.22 billion, a 38.8% rise compared to $2.32 billion in the prior year. Likewise, EPS for the TTM period turned positive at 15 cents, a significant improvement from minus $1.67. Representing a 108.98% increase. Free cash flow per share also strengthened to $1.76, up 87.23% from 94 cents, underscoring the company's enhanced cash-generating ability. Profitability metrics showed a gross profit margin of 45.97%, net profit margin of 1.62%, and a robust free cash flow margin of 18.66%, though returns remain modest with ROA at 0.47% and ROE at 1.8%. The balance sheet reflects a debt-to-equity ratio of 2.56, typical for a lending-driven model, but highlighting the importance of efficient capital management. Over the past 5 years, Affirm has grown its revenue at a 50.7% CAGR. Free cash flow turned positive in 2024, and net income turned positive in 2025 and has continued to grow rapidly. Affirm Fiscal 2026 Financial Forecast. Looking ahead, analysts forecast revenue for 2026 to grow to $3.98 billion, a 23.29% increase over 2025's $3.22 billion, while non-GAAP EPS expected to reach $2.44, up 39.42% from $1.75. Reflecting this positive outlook, Wall Street analysts have assigned Affirm a buy rating, with an average price target of $95.13, a 22.86% upside potential, and a high target of $115, suggesting potential gains of up to 48.47%. AFRM stock price performance and valuation. At the time this video was created, the stock was trading at $77.43 per share. Affirm's stock has delivered impressive returns over the past year, representing a 98.2% gain and significantly outperforming the S&P 517.6% increase during the same period. However, looking at a longer horizon, the stock remains down 33.8% since IPO in January 2021, lagging behind the S&P 578.1% rise, which highlights both the volatility and turnaround potential of the company. From a valuation perspective, Affirm trades at a price-to-sales PS ratio of 7.45 TTM, with a more attractive forward PS of 6.1. On earnings metrics, its non-GAAP PE stands at 40.39 TTM, with a forward PE of 30.56. Additionally, the price-to-free cash flow PFCF ratio is 41.91. While these multiples may appear high at first glance, they are supported by the company's rapid growth, margin improvements, and consistent positive free cash flow, making the stock still appealing for growth-oriented investors. Affirm growth potential. Affirm growth potential remains strong, driven by several factors. 1. Robust gross merchandise volume, GMV, and transaction growth. Affirm achieved a 43% year-over-year increase in gross merchandise volume, GMV, to $10.4 billion in Q4 2025, surpassing management expectations and analyst estimates. This growth was driven by expanding consumer adoption of flexible installment loan options and a significant rise in repeat usage, supported by 37.5 million transactions, a 52% increase from the prior year. Consumers are increasingly leveraging Affirm's payment solutions for both everyday expenses and larger purchases, which has boosted purchase frequency and average order values. This sustained GMV momentum propelled revenue up 33% year-over-year to $876 million. The higher transaction volumes also benefit merchant partners by reducing cart abandonment and increasing average sales, thereby creating a reinforcing cycle of adoption and network effects that strengthen Affirm's market position in the buy now, pay later sector. 2. Diversification and strength of the direct-to-consumer proposition. The Affirm card has become a key growth driver, enabling direct engagement with consumers beyond merchant checkouts. In Q4 2025, Affirm card GMV surged 132% year-over-year to $1.176 billion, while active cardholders nearly doubled to 2.3 million, growing 97%. This diversification lessens reliance on partner merchants and creates a recurring revenue stream from both in-store and digital spending. Since its launch, the card has developed into a sticky product, with 24% of transactions now processed through Affirm's own channels. Owning the customer relationship allows Affirm to offer personalized deals, boost cross-selling, and capture more wallet share. This enhances customer loyalty and lifetime value, establishing the Affirm card as an integral element of Affirm's expansion strategy and securing a stronger competitive position in the buy now, pay later market. 3. Expanding merchant ecosystem and international reach. As of Q4 2025, Affirm served 377,000 active merchants, reflecting a 24% year-over-year increase and broadening its total addressable market while mitigating concentration risk. Strategic collaborations with e-commerce platforms like Shopify facilitated Affirm's accelerated expansion into Western Europe, starting with France, Germany, and the Netherlands. This international rollout opens new revenue channels beyond North America. By integrating directly into merchant checkout and point-of-sale systems, Affirm reduces barriers for mid-sized and large retailers to adopt its buy now, pay later solution, driving deeper penetration across various retail categories. This geographic and merchant diversification enhances Affirm's resilience against regional economic shifts and creates stronger network effects as consumer and merchant engagement intensifies on the platform, reinforcing Affirm's competitive positioning and supporting sustainable long-term growth in global markets. Risks to consider. While Affirm growth prospect looks bright, we should be mindful of potential risks. 1. Competitive risks. Affirm operates in a highly competitive buy now, pay later market, facing rivals like Klarna, PayPal, Upstart, and traditional banks. This competition compresses profit margins and challenges growth as BNPL services commoditize. To maintain and grow its merchant and consumer base, Affirm must increase marketing spend and offer pricing incentives, putting pressure on its profitability while striving to differentiate through technology and customer trust. 2. Credit risk and economic sensitivity. Affirm has not yet faced a complete credit cycle, raising concerns about its ability to maintain credit quality during economic downturns marked by reduced spending and increased defaults. While Affirm's real-time underwriting system helps manage this risk, it cannot fully eliminate it, especially in economic slowdowns or recessions, where consumer financial strain intensifies. This credit risk remains a key challenge for Affirm as it grows. 3. Regulatory risks. Affirm faces rising regulatory scrutiny from agencies like the Consumer Financial Protection Bureau, which enforces consumer protection, lending transparency, and data privacy laws. Potential changes in BNPL regulations could increase compliance costs and restrict business operations. Affirm already invests significantly in compliance and legal expenses, but ongoing regulatory uncertainty remains a material risk that could impact its growth and profitability moving forward. Conclusion. Affirm Holdings has shown a remarkable turnaround with strong revenue growth, improving profitability, and robust free cash flow, signaling a shift toward long-term sustainability. Despite a volatile past and premium valuation, the company's growth prospects, expanding market opportunity, and analyst optimism position it as a compelling investment. With shares up nearly 100% in the past year and forecasts pointing to further upside, Affirm remains a strong candidate for investors seeking growth potential in fintech. But remember, this is not a financial advice. What do you think about Affirm? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching and see you in the next one.